So now we are going to talk about if there are differences in reporting date between the holding company and the subsidiary company, then how do you deal with the translation, right? And what are the rules around that? So as you must already be aware by now that under Ind AS 27, right, under the consolidation process, it is permitted to have a 3-month gap between the holding company closing date and the subsidiary foreign operations closing date, right? Though it is permitted, we don't see that too many companies in a way take benefit of this relaxation, right? But if you are, then it is perfectly permitted in a way from that perspective. And and then the key is that when you are going to use the translation, right? So for all your operations, you're going to translate the 31st March closing rate, right? And for the subsidiary, if let's say the foreign operation, if it's 31st December, you're going to use the exchange rate of 31st of December, right? So that's like a holding company and a subsidiary company. You follow 31st of March. Here it follows 31st of December. So I'm going to use this closing exchange rate of 31st of December. Here I'm going to use the closing exchange rate of 31st of December. I think that's the key, right? Let's say here the functional currency is INR, here the functional currency is GBP, and I'm translating this into, let's say both of them are getting translated into US dollar, right? So the closing exchange rate of US dollar, which I'm going to use here, INR to US dollar, will be of 31st of March, whereas GBP to US dollar will be of 31st of December, right? So Ind AS 27 allows the use of a different date, provided the difference is no greater than 3 months and adjustments are made for the effect of any significant transaction. So that's again an area of judgment. And we don't, in practice, we don't see too many adjustments. But if there are such significant transaction that we need to make the adjustment from that perspective. So, and then the assets and liabilities of the foreign operations are translated at the exchange rate at the end of the reporting period of the foreign operation. A similar approach is used in the equity method associates as well as joint venture in a way from that perspective. So when you do an equity or for joint operations, if you're doing, let's say, some kind of consolidation in case of joint operations or jointly controlled assets, again, you will follow the same principle. So you take the rate of exchange which is relevant of the reporting date of the entity which is getting consolidated, not the reporting date of the present of the main entity, consolidated entity, right? So every operations, you got to follow their closing date and the closing rate. Remember, for balance sheet, for assets and liability, use the closing rate. For equity box, you will use the historical rate. For P&L, you use the average rate, and this results into a resultant difference. That is your called currency translation reserve, foreign currency translation reserve. And we also experience that how do you do the reconciliation? How do you justify this foreign currency translation reserve is actually by way of translating all your closing balances, right, at the closing rate, your closing functional currency balances at the closing rate, and then you compare the closing reporting currency minus the actual reporting currency balance which is there in the consolidated financial statement, both for the equity box, the retained earning box, and for the current period in a way current period profit element, right? These three items in a way give rise to your foreign currency translation reserve. And we of course we also saw they could also have a foreign currency translation reserve because of intercompany loan, right? Intercompany loan for which the settlement is not planned in the foreseeable future. That could be another item, but that anyway comes through the normal process of revaluation. That doesn't come through the translation process. That comes through the revaluation process because that's a monetary item. It's a special accounting, which is a special classification of such foreign exchange gain or loss, which is permitted for such long-term foreign currency loans which are given to your own subsidiary, not to a third party, right? Not to a third party, only to your, in a way, subsidiaries for which the settlement is not planned in the near future, not likely. There's no intent. It's like a quasi equity, right? Okay. So if there are intra-group transaction, right? Again, the intra-group transactions, the balances like intercompany receivable, payable, intercompany sale and purchases, all of them are required to be eliminated, right, in the consolidated financial statement. But the foreign exchange gain or loss, which is rising on account of these transactions, they stay in the P&L. They are not eliminated in consolidated financial statement, except the one example which I talked about, which gets reclassified to other comprehensive income, right? So accordingly, in the consolidated financial statement of the reporting entity, the exchange difference arising on such intragroup transaction is recognized in the statement of P&L unless it arises from a monetary item that forms part of a reporting entity net investment in a foreign operation, in which case it takes to other comprehensive income and accumulated in a separate component of equity reclassified to P&L only on disposal of the foreign operations. So very, very little exceptions. Otherwise, all such foreign exchange losses in intercompany transaction, except those two items we've been talking about, then your designation of hedge of net investment in a foreign operation, or for your intercompany loan, long-term loan, for which the settlement is neither planned nor likely in the foreseeable future. I think these two goes to other comprehensive income. Everything else, in a way, stays in the P&L. So let's look at an example around this, right? So Sky Limited functional and presentation currency is GBP, while Cloud Corp functional currency is US dollar, right? The subsidiary functional currency is US dollar, and the parent functional currency and the presentation currency is GBP. That means the USD needs to be translated to GBP. Now, during the year, Sky Limited sold goods having a value of GBP 1000 to Cloud Corp, when the exchange rate was GBP 1 equals to USD 1.2, right? 1 GBP equals to 1.2 US dollars. At year end, the amount is still pending to be paid by Cloud Corp to Sky Limited, and the exchange rate is at the year end. The amount is still pending to be paid by Cloud Corp to Sky Limited, and the exchange rate is GBP 1 equals to USD 1.3. Okay, GBP 1 equals to USD 1.3. All right. So Sky Limited sold goods having a value this at the year end. Amount is still pending, the 1000 GBP, and the exchange rate is now 1.3. Okay. You are required to determine how should the exchange difference be accounted for in the consolidated financial statement. All right. So paid by Cloud Corp, right, which is the subsidiary, to Sky Limited. So I have to pay in GBP, right? And now the exchange rate has moved from 1.2 to 1. So when I did the initial recording of the transaction, right, I'm going to record in my functional currency, which is $1,200, which I recorded. And now I have to, but still have to pay 1000 GBP, right? So now for 1000 GBP, I will have to buy now $1,300. Okay. So if you see, because the exchange rate has moved here from 1.2 to 1.3 for 1000 GBP, right? So if you see 1000 GBP were equals to US dollar, right? 1200, right? At the date of transaction. But year end, what happened? Now the same 1000 GBP, and now if I have to pay, it has become 1300. That means what? I have $100 because I have a payable, right? I have to pay. There's $100 of exchange loss. Okay, there's $100 of exchange loss which has happened. Now this $100 of exchange loss will be recorded in the P&L of the consolidated company, right? So let's look at this. So at the year end, Cloud Corp should revalue its account payable, right, from USD 1200 to USD 1300, right? USD 1200 to USD 1300, recognizing a loss of USD 100 in its standalone profit or loss account, right? Now, in the books of the Cloud Corp, balance payable to Sky Limited will be shown at USD 1300, right? Which when you do the translation at 1.3, it will become 1000 GBP. While in the books of Sky Limited, the receivable balance from Cloud Corp will be GBP 1000. Okay. Now, during consolidation by Sky Limited, the assets and liabilities of Cloud Corp will be translated to GBP at the closing rate of 1.3, right? 1000 will get eliminated against the receivable in the books of Sky Limited with payable in the books of the Cloud Corp. But the US dollar 100, so this, the receivable and the payable, right? The asset and the liability. So if you look at, this is my cloud, okay, and then we have the sky. Okay, now cloud has recorded, let's say in the functional currency, $1,300, and in the presentation currency, right? What is the exchange rate I'm going to use? 1.3, so it will become 1000 GBP. Okay, it will become 1000 GBP, and here it is dollars. And in the books of Sky, the receivable is anyway pound 100,000, right? So in the consolidated financial statement, these will get eliminated, right? 1000 receivable and payable will get eliminated, right? But the US dollar 100 exchange loss recorded in the Cloud Corp statement of profit and loss has no equivalent gain, because in the books of Sky there is no gain, because they sold in their functional currency. They want to receive money in the functional currency, same 1000 GBP. So for them there is no gain or loss. Therefore, the USD 100 loss will remain in the consolidated statement of profit and loss. The reason for this is that the intra-group balance represents a commitment to translate USD into GBP, and this is similar to holding a foreign currency assets in the parent company. All right. The subsidiary must go out and buy GBP. That is what you will have to do to settle the obligation to the parent. So the group as a whole has an exposure to foreign currency risk. And similarly, the income expense, also the sale and purchase, also gets eliminated at the same 1,000. There could be if there are different exchange rates being used on the elimination of elimination of the sale and purchase, that difference in the consolidated financial statement goes and sits into currency translation reserve from that perspective. Let's try and understand this with the help of an example. The functional currency of Big Limited is GBP, and Small Corp again is US dollar. Big Limited reporting date is 31st of December. All right. On June 30th, 2018, Big Limited, okay, lends GBP 2000 to Small Corp. Okay, Big is big, but on receipt of the amount in GBP, Small Corp converts the cash to US dollar. On the day I receive, I convert the cash to US dollar. Exchange rate at 30th June 2018, GBP 1 equals to 1.25 USD. Exchange rate on closing date, GBP 1 equals to USD 1.5. Now, you are required to show the accounting treatment of our transaction in the books of Big Limited and Small Corp. Okay, so you have to essentially record the gain or loss in the books of the big and in the books of the small, right? So let's look at the transactions. So GBP is the functional currency of big, and small functional currency is USD. I've given a GBP loan to small, right, for £2,000, and then I had a exchange rate on the date of transaction was 1.25, and then the exchange rate at the year end, the loan is still outstanding, is 1.5. Okay, so let's look at the solution in the books of the small, the subsidiary, right? I'm going to record cash account debit 2,500, which is nothing but essentially 2,000 GBP, right, into 1.25, right? You get to 2,500. So I did the debit and the credit, right? Cash account debit to loan account, and then on December 31st, I have to repay GBP how much? 2,000. Now the exchange rate has moved to 1.5. So there is a 25 basis point loss in a way which I have. So I'm going to record a loss of, so that means the dollar payable should be in my books now at 3,000, which is 2,000 into 1.5. So I have a payable of 2,500. So I'm going to record a loss of 500 in a way and increase the payable by 500 amount. So there is a loss which I need to record in the Small Corp, right? Now, when we go, so that's the loss on remeasurement is recorded. It's a monetary liability, right? So now when I go in the books of the Big Limited, is there a gain or a loss? There is no gain or a loss. So I've given a loan to my subsidiary. So I'm going to record, small corp debit, and then intragroup receivable debit, and to cash, which is 2,000 GBP. Now there is no gain or loss. In a way, and then you do consolidated financial statement, the intercompany payable or receivable will be eliminated, but the exchange loss of $500, right? The exchange loss of $500 will stay in the consolidated P&L. It is not appropriate to transfer the exchange loss to equity on consolidation. All right. Okay. So now let's look at some of the other kind of nuance in the consolidated financial statement, and that arises because of a business combination. So if there are a goodwill and fair value adjustment arising from a business combination, so what happens is, let's say you are, again, the same thing, you are a GBP functional currency, right? And you do a US dollar acquisition. You do an acquisition in for a company whose functional currency is US dollar. Okay. So essentially what's happening is that, and when you do actually the computation of goodwill and other intangibles which arises in a business combination, and you will learn a lot about this once we will do Ind AS 103, right? Once you will go through the principles of Ind AS 103. So what essentially we are trying to say, let's say I've done a business combination for which I paid, let's say, 5 million GBP. I paid a 5 million GBP, and then I got a net assets of, say, 5 million was my purchase consideration. I got a net assets of 3 million GBP, right? Net assets, and then 2 million is my goodwill. Okay. So that was, let's say, the transaction. But this actually transaction relates to this entity, right? Whose functional currency is US dollar, whose functional currency is US dollar. So essentially what we're trying to say is that when you to record this transaction, right, there could be a foreign so you're going to record this and you're going to push it down to the subsidiary, right? And that there will be some volatility because of that exchange rate, right? Because it belongs to that subsidiary. So let's just go through the principle. Goodwill and fair value acquisition accounting adjustment arising from a business combination are treated as assets and liabilities of the foreign operation. They are treated as, this 2 million treated as the asset of the foreign operations in a way from that perspective. Hence, they are expressed in the functional currency of the foreign operation, okay, and should be translated at the closing exchange rate in the case for other assets, as in the case for other assets and liabilities. So what happens that then it results into a translation gain or loss, which is arising only on consolidation. This translation gain or loss is only arising on consolidation, because in the standalone books of this company, right, it is there as investment. It's sitting as investment, right? Here it is sitting as capital, right? Now, when you look at the consolidated financial statement, this investment and capital is eliminated, right? Now, that is represented by then these assets, okay? That is represented by this asset. Now, this 2 million, which is actually then is a consolidation adjustment. Goodwill is a consolidation adjustment. You know, you have to also make sure that this 2 million is represented in the equivalent US dollar on the closing date, because this goodwill pertains to this operations, okay? And this has a significant impact actually while you are making an assessment of impairment. While you are making an impairment assessment, this can at times help you assess, or it may have an impact that how much goodwill needs to be impaired, right? From that perspective. Now, if you are doing a disposal or partial disposal of a foreign operation, so when do you now this currency translation reserve gets transferred to the P&L? That's the principle, is what we are trying to understand here. A disposal may arise, for example, through sale, liquidation, or repayment of share capital. On disposal of foreign operation, the cumulative exchange difference, if you were to sell your foreign operations, okay, the cumulative exchange difference relating to the foreign operations, right? Foreign operations, I'm sure you're clear by now, right? Which is a branch, which is a subsidiary, which is a foreign operations, right? Independent set of activities is what you are doing, which has their independent existence, right? Which you assess the primary economic environment, which is the to say that with reference to sale, with reference to cost, with reference to, we saw several examples, right? Are you dependent on the parent or you have their own existence? So the cumulative exchange differences arising, relating to the foreign operations recognized in other comprehensive income, OCI, in equity are then reclassified to P&L when the gain or loss on disposal is recognized, okay? When the gain or loss on disposal is recognized. Now, on disposal of a subsidiary that includes a foreign operations, right? The cumulative amount of the exchange differences related to that foreign operations that have been attributed to the non-controlling interest, which form part of the non-controlling interest that is de-recognized and is included in calculation of the gain or loss on disposal, but it is not reclassified to profit or loss account, right? So if you have a non-controlling interest, right, in a subsidiary, and you dispose that, then for the foreign currency translation result, which is allocable to that non-controlling interest, that gets allocated, and then you do the overall computation of gain or loss on disposal of that foreign operations, right, from that perspective. Now, if there is a partial, in a way, disposal, right? So, in addition to the disposal of an entity, entire interest in foreign operations, the following are accounted for as disposal, even if the entity retains an interest, right, in the subsidiary, associate, or jointly controlled entity. The loss of a control of a subsidiary. So, even if you've sold it, but you've lost the control, right? The loss of significant influence over an associate, the loss of a joint arrangement over a joint, that means the status has changed. It is no longer my subsidiary because I've lost it. It is no longer my associate because I've lost the interest. It is no longer my jointly controlled entity because I've lost the, in a way, arrangement. So in that case, the FCTR, the foreign currency translation reserve, in relation to those investments, right, they also needs to be then reclassified to profit and loss account, right, from FCTR to profit and loss account, in proportion to the disposal. Okay. Let's look at the example. Sun Limited owns 100% in Earth Limited, right? The parent owns 100% in Earth Limited. During the year, Sun Limited sells 65% of its investment in Earth Limited and thus loses control of Earth Limited. Okay. So Sun Limited owns 100% in Earth Limited. Okay, Sun Limited owns 100% in Earth Limited. During the year, Sun Limited sells 65%, right? I mean, 35 is now the interest which I have retained, but 65% is what I have sold, right? That is, I have lost control. It's no longer my subsidiary. On the date of disposal, the entire balance in the foreign currency translation reserve in respect of Earth Limited is reclassified to profit and loss account. Now, if there is a partial disposal, okay, of an entity interest in a foreign operation, is any reduction in an entity ownership interest in a foreign operation, except for those reductions that are accounted for as disposal. Now, in case of a partial disposal that includes a foreign operation, the entity reattributes a proportionate share of the cumulative amount of the exchange differences recognized in other comprehensive income to the NCI in the foreign operations. If there is a partial disposal of my interest in the subsidiary, I still retain the control, then I will reallocate the FCTR as well to the non-controlling interest, right? To the non-controlling interest. In any other partial disposal of a foreign operation, the entity reclassify the profit or loss only the proportionate share of the cumulative amount of the exchange difference recognized in other comprehensive income, which is like for equity method associate or for joint venture arrangements from that perspective. Okay. Because when you're doing the equity pickup, you not only do the pickup of the profit, you also do the pickup of the equity balances. And from the equity balance pickup, you also get the FCTR of that subsidiary, of that associate as well. Okay, and we'll talk, a lot more, and you should practice a lot more with the help of several examples, right? As you do the consolidation module, right, which is Ind AS 110. So, and that's a very, very important module from an examination perspective. Let's take an example here. Sun Limited owns 100% in Earth Limited. Okay, during the year, Sun Limited sells 15% of its investment in Earth Limited. So it's a non-controlling interest. However, control is retained by Sun Limited. In this case, 15% of the balance in foreign currency translation reserve is reclassified to NCI. Nothing goes to P&L. It simply gets reclassified to, because when you are actually doing a control to control, that means I'm still in control, nothing goes to the P&L. It's an equity box reclassification as it is there, right? Now, Alpha Limited, right? Alpha Limited owns 45% of Beta Limited. Now, during the year, Alpha Limited sells 15% stake in Beta Limited, however, still retains significant influence over Beta Limited, right? So, in this scenario, 1/3 of the balance in the foreign currency translation is reclassified. It's a partial disposal. It's a partial disposal. All right. So if there are tax effect of all exchange differences, you need to be mindful of that as well. That do I need to set up a deferred tax asset or a liability in relation to a tax effect of all exchange differences? And again, if you go to the Ind AS 12, you will see that there is an exception here to this rule to say that if you can demonstrate that you have the ability to liquidate this in a tax-free manner, or you will continue to reinvest this, that means there will be no repatriation of this exchange gain or loss, then you don't need to set up, deferred tax asset or a liability. So Ind AS 12 applies to the tax effect of gains and losses on foreign currency transactions and exchange differences arising on translating the results and financial position of an entity into a different currency. And there is an exception here. There is an exception to this rule. We'll talk in more detail, right, when we want to go through Ind AS 12. So to summarize, what all we have talked about. We talked about foreign operations. So you have operations which are in a currency which is other than your functional currency, that these are like foreign operations. If you were to dispose your investments of foreign operations, we talked about if you have for FCTR, that gets reclassified to PNL. If you do a partial disposal, then you do a proportionate reclassification to PNL. Only in the if you do a partial disposal of a subsidiary but you still retain the control, then you do the reclassification to NCI. But in the case of a subsidiary, if you loses the control, then the entire FCTR balance gets reclassified to profit and loss account. We talked about the translation approach to say how you look at your assets, which are your assets. All the assets gets translated at the closing rate. Your liabilities gets translated at the closing rate. Your P&L items gets translated at the average rate. Your equity box gets translated at the historical rate, and that results into a foreign currency translation reserve. And we also saw how you do the reconciliation. And we also talked about if there are different reporting dates, right? How do you in a way deal with all different reporting dates from that perspective? It's permitted to have a 3-month difference between the holding company and the subsidiary company period end, and you will use the rate which are prevailing on the date of the balance sheet of respective entities which are getting consolidated, right? And if there are some significant transactions which are happening in the intervening period, then you need to of course true up for those significant transactions as well. Now, in terms of disclose, accounting policy, disclose P&L items are translated at rate, at transaction dates, or average rate. Why there has been a change if there is a change in the functional currency, and we talked about it, the change in functional currency is considered to be remote, right, or a rare event, and you only change it if there are significant change in your primary economic environment, right? And how you determine your primary economic environment with reference to sales, cost, financing, and your cash flows. And then we also saw in the case of your intercompany dependencies, you look at that also to assess your primary economic environment. Why the presentation currency and the functional currency are different, you need to possibly explain that. If the entity additional financial information is displayed in a currency different from either its functional or presentation currency, clearly identify such information is supplementary, it's non-GAAP in nature. Why are we disclosing that? All of that is what you need to explain and disclose, right? So lots of disclosure again in relation to foreign currency transactions under Ind AS 21. Differences between Indian GAAP and Ind AS, there is a whole lot of similarity, but there are some differences, right? On the forward exchange contract and other similar financial instrument from Ind AS has been excluded, dealt in Ind AS 109. Indian GAAP includes accounting for such contracts, right? And exchange differences arising on translation of long-term monetary item, right, from foreign currency to functional currency. In DS 21, we talked about, you get some benefit, and you can there is some transition exemption also available. And hence there is some relaxation under the Indian GAAP. It can go to a reserve, and then you get amortization and all of that, right, over the life of the relevant liability asset, not related to acquisition of fixed asset in a way from that perspective. Some more differences, right? The approach for a translation in DS 21 is based on the functional currency approach, whereas AS 11 is based on integral and non-integral, though the accounting answers generally are the same, right? from that perspective. The presentation currency, as per Ind AS 21, the presentation currency can be different from local currency, and it gives detailed guidance. However, if you're an Indian company, your presentation currency has to be INR, because that's required under Schedule 3, right? But if you're an Indian company, you want to present, for any other purpose, you can have a presentation currency, not, other than INR as well. AS 11 is, in a way, silent on it. All right. So with this, we are done with this. Thank you very much. Look forward to continue this dialogue, and I'm going to let my colleague take you through a few more questions around this. But practice, practice, practice. Right? That's the most important stuff. Thank you.